Hey everyone, welcome to Lead an Indicator. It's a show by Public.com focused on gaining insights from the world's very best macro minds. I'm your host today, JD Durkin. We are with you today to discuss a bit of a debrief to the September FOMC meeting. As always, don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help keep your portfolio on track. With me today is Joseph Wang of FedGuide.com to discuss the central bank's path forward from here. Joseph, thanks a lot for taking the time. It's really good to have you with us.
Great to be here, JD.
So, I think at this point, investors are very aware of the Fed's decision here to skip, pause, whatever word you want to use here. We saw the decision for September. But the Fed also gave us some pretty detailed insight, I would argue, into expectations for future economic health and overall monetary policy. Let's start with an examination of the macro estimates, Joseph. The central bank upgraded economic growth expectations for the year from 1% to 2% from where you sit. What do you see as being the reasoning for that move? And give us some context to that. Why is it a big deal?
I think it's a huge deal, and it helps us understand why they also significantly revised the path of policy forward higher. So let's rewind a little bit. So earlier in the year, the Fed was thinking that, GDP growth this year might be around 1%. Now, for some background, the Fed thinks that the trend growth in the US is about 1.8%. So they were thinking that the US would grow below trend pretty meaningfully this year. But when we got first quarter GDP, though, it was above 2%. Second quarter GDP, also above 2%. Third quarter GDP, this quarter, isn't out yet, but it looks like it's going to be really good as well. So it seems like the Fed has really underestimated the US economy. They were thinking that growth would slow and that would bring inflation back towards 2% faster than they expected. But that hasn't happened. So they have to recognize that, they've been a bit more pessimistic and upgraded, as you noted, the growth from 1% this year to 2%. And in line with that, they also envision rate cuts next year. Rather than the 100 basis points of rate hikes they penciled in June, they're only penciling in 2 rate cuts next year. So in a sense, they're thinking that rates will be higher for longer. And I think the market immediately saw that, and you saw a pretty hawkish impact. The dollar strengthening, equity selling off, and treasury yields rising.
Yeah, a bit of a Fed hangover today. We've had several instances where Chairman Powell and his colleagues have come out over the course of the last year and a half or so, Joseph, and it says, all right, sorry, folks, it's going to be higher. We're going to be elevated levels for a little bit longer than we previously expected. Were you surprised to hear that this was the consensus? This is where we wound up for the September meeting with 2 meetings on the books between now and the end of the calendar year?
So when I'm thinking about the higher for longer framework, I'm looking at it through a couple of different time periods. Just the overall long-term, the long-term rate, let's say R star, and I'm looking at it towards a more short-dated and medium term. Now, the revision of 100 basis points of cuts to 50 basis points of cuts caught me by surprise, and I think it caught the market by surprise as well, which is why you see such a strong reaction. But one other thing that I would like to focus on is the Fed's view of the longer-term trend for interest rates, what the Fed thinks of as R star. So if you're the Fed, you think that there's this level of interest rates where, that is neither restrictive nor accommodative for the economy. That neutral rate is the benchmark you use to judge whether or not monetary policy is accommodative. When you raise interest rates above that neutral rate, you're trying to slow the economy down. And when you keep interest rates below that level, you're trying to ease monetary policy. So what I noticed really interesting in the dot plot is that it seems like more and more people on the Fed are thinking that the neutral rate has gone higher. Right now, the median person on the Fed still thinks that the neutral rate is around 0.5% in real terms, but you can also see that the distribution is tilting upwards. Now that tells me that there's more and more people at the Fed that think that, the world is changing, interest rates are going to stay higher for longer, not just over the next few years, but let's say maybe the next 10 years.
So, Joseph, since you're the Fed guy, let's take one step back. I'm willing to bet we've got some viewer that's watching this interview right now and says, I see these headlines every Fed meeting. Sometimes there's this thing called the dot plot. Sometimes they're not. It has something to do with projections. Can you first kind of lay out what the dot plot is, why it's important for a meeting like September? Obviously, we don't get it every meeting, but what is the actual information, and what does it tell us about where monetary policy could be going from here?
Great. We should definitely have some background on that. Very important. So I would just actually level set up. So if you move, let's say, go back, let's say 10, 20 years ago, the Fed was actually a very mysterious organization. You'd have Chair Greenspan of the time basically sometimes hike rates and not even tell anyone about it. You kind of have to find out by looking closely at the market. But since then, the Fed has become progressively more transparent in how it communicates what it's thinking. Now, Chair Bernanke really started something called the dot plots, which is what we get now every quarter. The dot plots are basically where every member of the Federal Open Markets Committee pencils down where they think interest rates, GDP, inflation, and unemployment will be over the next few years. So when you look at the dot plot, every dot represents the view of one FOMC participant. So you can kind of get a sense, just looking at the graph, just where the committee is as a whole. Now, there's a wide dispersion of views, as we can see in the dots. But we also want to focus on the medium dots, since that is, at this point in time, the most likely path going forward. Now, what we see in the most recent dot plots is just pretty good consensus that we maybe have one hike or maybe zero hikes this year, but beyond, we begin to see more disagreement. The dots become more dispersed, but just the tendency of the dots helps the market and investors understand what the Fed is thinking and what the future might look like, so they don't get caught off guard.
So Joseph, let me ask you a little bit more about when this potential next rate hike may be. I'm taking a look at the CME Group FedWatch tool. It's a favorite go-to tool. It tells us right now there is nearly a 74% chance of another hold for November. So right now we're between 5.25 and 5.5. If you jump ahead to the December 13th decision, it looks like that number does come down a bit, but stays in the same range to about 54%. What is sort of your base case versus market participants, at least according to that FedWatch tool that we follow very closely week in and week out?
So my base case is that we do get another rate hike this year, probably in December. So this is how I'm thinking about it. So in June, Fed penciled in 2 more hikes. And since then, growth has come in stronger than expected. So we already had 1 hike, so that would be 1 more hike by the end of this year, which was affirmed in the September dot plot. So there are a couple of things that I think are pushing more towards this. One is, of course, growth is stronger than expected. Secondly is, when I'm looking at energy prices, I can't help but notice that oil has just gone up basically every day. And so that's going to bleed into headline inflation, which I think could potentially start raising inflation expectations. As everyone in the public is seeing high prices at the pump, maybe they might be ratcheting up their expectations for inflation in the future, and the Fed might want to be seen as trying to do something about it by putting in 1 more hike. Now, an extra 25 basis points, I don't think it has a big impact on the macroeconomy, but I do think they want to be shown to be doing something. And after all, if they're wrong, they can just cut rates. It's really not a big deal.
Obviously, when it comes, Joseph, to kind of gauging where inflation actually is, we follow lots of little teeny tiny data points, right? We got CPI, we got PPI, we've got PCE, we've got these core services, X housing, right? I mean, we go on and on. Are there key metrics that you follow that you believe that Chairman Powell and the voting members of the Federal Open Markets Committee are uniquely more following than others? Obviously, we follow the big headline stuff because every week or couple weeks we get a new bit of information. But what's really most important in terms of having confidence that inflation actually is nearing that 2% target?
The Fed's favorite measure of inflation is something called core PCE. And so far, that measure of inflation has been going the right direction. And so the FOMC committee looks at that and feels like they're making pretty good progress. Now, when they look at this, though, there's always a time element to it as well, because they're afraid that if it takes them too long to get inflation under control, maybe inflation expectations would get unbound, and then it becomes more difficult to control, and that's what happens in the 1970s and 80s. Thankfully, based on the measurements that they're looking at right now, inflation expectations look very well anchored, and so they're feeling pretty comfortable. So that's why it doesn't seem like they're in a hurry to hike anymore, but more content to basically hold where they are, maybe 1 more hike, and just let inflation go back down towards their target. At least that is what they're forecasting. It seems to be moving towards there, to be clear.
Joseph, we were talking a moment ago about dot plot projections. Do we have any sense historically how accurate dot plot projections have been, either through the long-term lens of history or even the dot plot projections we've gotten over the course of the last year? Have they proven to be relatively true with the passage of time, I wonder?
Well, Chair Powell was asked about forecasting at the press conference yesterday, and he noted that forecasters have to be humble, and they have much to be humble about. So the dot plot, to be perfectly honest, sometimes it's wrong significantly because things change. Sometimes they're wrong really suddenly too. I remember I believe it was 2018, the December of 2018 dot plot was penciling in 3 more hikes in 2019. And then come early 2019, the Fed actually, basically started giving speeches telling everyone that, we're changing our mind and maybe we're going to cut rates. So it was very much a 180 from projecting lots of rate hikes to rate cuts. So the dot plot is sometimes a very poor indicator of what the Fed would do. However, I also have to point out that over the past 1 to 2 years, the dot plot has been much, much more accurate than the market when it comes to judging what the Fed would do. The market has been, over the past year and a half, consistently been saying that the Fed is not going to hike a lot, and even if they do, they're going to cut rates very quickly. The Fed has been pushing against that with their dot plots over the past year and a half, and the Fed has been completely right. So again, the future is difficult to predict. The dot plots are simply the best projection at this moment in time. And if events change, well, the dot plots will be much less valid.
Yeah, Joseph, one of the things I love most about Fed Day is not just the very carefully prepared remarks that Chairman Powell makes to members of the press, but it's really that question and answer portion, right? It's when the man's got to be off book, off script. Yeah, he may have his talking points, but you really kind of get into the little bit of the weeds of ambiguity a little bit to try and figure out how he's thinking. Anything from yesterday's press conference, maybe especially in the question and answer portion, that stood out to you, that maybe even anything that maybe the chairman maybe did not expect to talk about, but of course, when you get asked a question in front of everyone in the room, it's obviously all eyes on what Mr. Powell has to say.
I totally agree, JD. The question and answer session is, in my view, the most valuable session because you get to have some candid interactions. I think a couple comments that Chair Powell made were interesting to me. One is that, just looking at why the economy has been more resilient to rate hikes than expected, Chair Powell appeared to be open-minded to the idea that, the economy has become more rate resistant, R-star is higher, and that could suggest that going forward, rates would have to stay higher than we otherwise would expect. The other comment that he made that I found was interesting was trying to explain why longer-dated treasury yields have risen so much. His view seemed to be that he finds the common narratives we hear in the market to be persuasive. That is to say, first, treasury issuance has been very high. Obviously, supply and demand. If you're issuing, let's say, $1.5 to $2 trillion in treasuries a year and expect to do so basically forever, obviously the price of treasuries is going to go down, yields higher. And he also seemed to suggest that it could also be due to stronger economic growth, that is to say, higher real yields. And we also see that in the market as well. And indeed, economic growth is stronger. So I appreciated that explanation. It helps to confirm what me and many other people in the markets have been observing.
Well, there's truly no one better to talk all things Fed than the Fed guy himself, Joseph Wang of FedGuy.com. Joseph, thanks a lot for the great perspective and context. Great to have you on the show today.
My pleasure. Thanks for inviting me.